Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Chinese equities rally after better than expected GDP data and retail sales in the country as the PBOC steps up support to help prop up the world's second largest economy. The European Central Bank expectedly cuts rates as investors see another cut in December. Meanwhile, the latest US economic data, cool bets of Fed easing, and gold hits a fresh record with investors heading for safety. Israel killed Hamas leader Yahya Sinwar, the architect of the October 7th attacks, leaving a hole at the top of the militant group. The US increases pressure on Prime Minister Netanyahu to end the war in Gaza.
In light of those headlines, a quick market check here because you are seeing a little bit of risk-off sentiment here. Futures virtually unchanged for the Euro Stock 50. The FTSE 100 underperforming this morning by a tune of 0.2%. To me, what's interesting is what's happening in the gold and bond market. Gold, of course, hitting a record high, as Anna just mentioned, but the bond market starting to see some steepening, a bit into the front end, selling off in the back end. 409 on your 10-year over in the States. The countdown to the opening trade starts right now.
Friday morning, good morning. The US consumer is alive and well. The bedrock of the US economy, of course, is spending. This is a critical factor that everybody needs to pay attention to. The data on retail sales yesterday was very, very, very strong. And the UK is not too far behind, Anna.
Yeah, absolutely. I was all set to tell you that the weather had been wet and therefore people weren't spending money, but that doesn't seem to have been the story. So we've got strong retail sales coming out this morning, including auto fuel year on year, up 3.9%. And that was against a survey of 3.2. So these numbers are better than had been anticipated. And it kind of throws the week on its head because earlier on, just days ago, we were talking about inflation coming in below target. The pound dropped. Today, the data's above target and the pound's on the rise.
It's interesting that we are seeing actually the consumer in many parts of the world doing better than anticipated. You can see that to a certain extent in China as well. The data they had overnight, fairly mixed in terms of the numbers that have been delivered in this data dump. The retail sales component was actually fairly strong. The industrial production data was actually fairly strong as well. GDP depends which component you're looking at, but looks fairly good as well. Certainly not too bad. We're into the kind of 4.8 on the average up until this point for the full year. Does that make 5% realistic? I think that's the critical thing here. What is interesting is that the Chinese felt that post this data and just a moment after it, that we needed maybe some extra market help, Kriti. And what we saw was the PBOC governor, the PBOC out with fresh impetus for the stock market in particular, driving the possibility of further buybacks. We need to find a buyer for these stocks. Maybe the companies themselves are the right buyers.
Yeah, on the surface, I'm having a little bit of deja vu in that, oh, look, it's China with another policy measure. Yep. Will the markets actually appreciate it? But then you look at some of the economist commentary off the back of it. Bloomberg Economics, for example, saying this might mean that the economy has bottomed out, that there's only upside here. I don't think I've heard that on China in a very long time.
Yeah, there's certainly one of the arguments, isn't it? I mean, yes, it's interesting, though, that it did take that PBOC announcement to brighten the mood. Yep. Investors didn't seem entirely convinced. There was the argument you make about, bottoming out in data, but it didn't seem as if the data really gripped sentiment and pushed it higher. But we saw something of a risk rebound through the Asia session as the PBOC was speaking, as they were talking about starting support, a program of share buybacks. That seems to have been what has moved the markets this Friday, at least.
It does seem as if we are teetering kind of on the edge of doom and gloom or exuberance on a daily basis. We can't work out which way we're going to go. The stimulus thus far, apart from the initial package, seems to have disappointed, but expectations were high initially. I think it really depends on your time frame. If you're trading this day to day, I think it's a really tough one to call. Are we doing enough, though? Are the data bottoming out? Yeah. Is the stimulus in aggregate going to be enough to lift the story?
Well, there's implementation of it on a fiscal level and then a local level as well, which has been the kind of hurdle for a lot of this Chinese stimulus, where they have it done from the PBOC and the capital markets perspective, and then the local municipal governments haven't been able to fully execute. Maybe this time will be different.
Yeah, let's take our conversation about markets global then. We've already talked about the retail sales theme coming out of the States yesterday, but that was one of the data points that ongoing helps to reset expectations about what the Fed is going to do. So we're not quite pricing in 2 full cuts from the Fed now. This after the jobs came in hot, CPI came in hot, now retail sales looking robust. So that's the story stateside. That, of course, takes a toll on the yen. And so we see verbal intervention coming through overnight from the Japanese FX chief, talking about sudden moves in the currency not being welcome. So we continue to watch that. But it does seem to be that US data and the repricing of the Fed on the back of that's moving markets at this point.
Was 50 the right call at the end of the day? How many times have we discussed this? To me, the bond market, I think, is fascinating. You are seeing a bid into the front end, but we're going back to 409 on the 10-year. Yield on the 10-year higher and higher. Are we not talking again about a ceiling of potentially 5%?
Within the last few days, I've heard people talking about 6%.
Yeah.
It is not a million miles away at this point. We've broken through 4. We're holding above 4. The real standout story yesterday in terms of the retail sales data was the control group numbers. Sales there up 0.7 month on month, the estimate 0.3. That is the number that gets folded into GDP. And the GDP estimates, if you look at the nowcast, are rising rapidly. This feels like it's an economy that maybe it's re-accelerating.
Shall we pivot from the economics to some of the geopolitics that's been developing at pace over the past 24 hours?
Absolutely. And arguably interrelated, Israel says it will continue fighting the war in Gaza even after the death of the Hamas leader Yahya Sinwar. The U.S. President Joe Biden has said his death presents an opportunity to end the war in Gaza. Let's get a little bit more context. Bloomberg's Horizon's Middle East and Africa anchor Jumana Bercetchi joins the program. Jumana, put this into context for us. Does this change the trajectory of what we see in Gaza?
Well, certainly many in the international community are hoping that is going to be the case. It is another significant moment in the unfolding of events in the Middle East, and certainly not the first time that Israeli forces went after Yahya Sinwar, but it has emerged now per Israeli forces that he was indeed eliminated in a strike that took place on Wednesday evening, and what could be described as almost a chance encounter. It took a while even for the Israeli army to identify that the target was Yahya Sinwar himself. And he, of course, was a key and central figure within Hamas over the last couple of decades, is known to be as one of the masterminds behind the October 7 attacks. So is yet another victory for Netanyahu and his government in the context of all of the killing of the other senior leaders from Hamas and indeed Hezbollah over the last month. But the question from here is what it means for those ceasefire discussions. President Biden has said in response, in comments yesterday, that this is now an opportunity for a day after in Gaza without Hamas in power. The Secretary of State, Anthony Blinken, will be making his 11th trip to the region in the coming days to help push forward those ceasefire discussions. But the questions remain, who will replace Yahya Sinwar? Will that person be more open to ceasefire discussions? And indeed, from the Israeli perspective, is the release of those hostages enough for Netanyahu and the government to say that enough has been done vis-a-vis their military campaign? And certainly the Israeli Prime Minister has been criticized for wanting to prolong this war, namely on back of political considerations and on back of pressure from members within his own cabinet who do not want to see any discussions take place between Israel and Hamas leadership. So still a lot of questions remain.
Bloomberg's Horizon Middle East and Africa anchor Jumana Bercetchi giving us that crucial context this morning. We thank you so much. This is an interesting one because we don't necessarily see a market reaction off of these developments. But I think the next steps, as Jumana was pointing out, are crucial in terms of what does the next steps for Israel look like in terms of retaliation, or do you have some sort of retaliation from Iran? The other piece I want to bring into this is that she mentioned Anthony Blinken and how crucial his trips have been to the Middle East. In about 2 months' time, we could see that policy change, especially towards Iran, especially towards the Middle East. Were we to see a new administration? Yeah,
I mean, just so many questions left unanswered here. Who runs Hamas after this? How does it change the way that Israel is behaving in the region? All of these things still unanswered, hours after we have had confirmation of his death. So that's key. In terms of market reaction, I did think it was interesting that we are seeing a bid into havens. So and this might be entirely to do with the US election and not necessarily about the Middle East. But if people thought that this might be something that would remove tension, the market isn't telling us that right now.
Why are people buying gold? I think it's a really tricky question to answer right now. There seems to be multiple answers to that question. But people are, and the gold price continues to rise. Is it a concern about geopolitics? Is it a concern about the use of the dollar as a weapon? Is it concern about the amount of debt there exists in the world right now and serious concerns about that? There's a number of different potential answers to this, but it continues to drive higher. Yeah. Silver's hot on its heels.
Because if it was moving on Fed expectations, it shouldn't be doing what it's doing and heading to these new highs. So that's an interesting one. Something is pushing it higher. And you could have seen how these developments in the Middle East might have led to reduced tension or a suggestion that that's what's going to happen from here. But that's not necessarily what we're seeing in the gold price.
Yeah, jitters very much in the market. It might simply be as easy as this is a hedge for the near term, the next couple of weeks, 19 days until the U.S. election.
Could be that. There's also an awful lot of liquidity in the system right now. Has to go somewhere. Maybe gold's the right place for it to go. Let's talk about what we've got coming up on the show. Christine Lagarde yesterday, front and centre, talking about the deflationary story that we're beginning to see emerging in core Europe. Are we starting to see that spread to peripheral Europe? And by peripheral Europe, I mean definitely peripheral Europe. When I'm not talking about Spain and Italy here, I'm talking about outside the Eurozone. We're going to find out the answer to that question. The EBRD's chief economist is going to be joining us shortly to recap all of that. We'll talk about what is happening in the Middle East. We'll talk about what's happening in Ukraine as well. Viktor Hjort, BNP Paribas, will be joining us in a few minutes' time as well to talk global credit. At the Open, we're going to speak to PGIM's fixed income Co-CIO, Greg Peters, is going to be with us. And Nadia Wiggen from Svelland Capital will come and chat energy and commodities. We will definitely be talking about what the gold price tells her about what is happening in the world right now, Kriti.
And whether or not that is related to the geopolitics at the end of the day, that's going to be something that's in discussion in some of the events in the day ahead. Biden is going to be making a trip to Germany. He's due to meet Olaf Scholz, but then we'll be joined by Keir Starmer and Emmanuel Macron as well. Of course, geopolitics heavy on the mind of those four leaders, but we're also going to get plenty of comments from the monetary front as well. Over in the Fed, Neil Kashkari, Christopher Waller, and Raphael Bostic will all be speaking today. Plus, of course, at 1:30 p.m. UK time, we get those U.S. housing starts. But there is a lot to digest. And again, I'm curious what comes out of that meeting in Germany. If again, we are only 19 days away from the election, is this simply just good vibes, or is there more to it?
Right, yes. I mean, he is going to be meeting. So Biden meets with Scholz. He also meets with Starmer and with Macron. So this is a sort of quad meeting. And the figure of the possibility of another Trump presidency will certainly hang over this and hang over all of the conversations they have about Ukraine. And you wonder what value in the commitments that the US can make right now under Biden with that in mind.
The Biden presidency in its last days, lame duck, you could argue, since effectively saw a change in leadership on the ticket for the Democrats. Europe feels like it needs some calming down, though, right now. There's a lot of concern about what the potential for a Trump presidency means for Europe, and that concern could be justified.
We should mention, though, even with that kind of tight time squeeze that you're going to see, Biden had a trip scheduled to Germany before. It had to be rescheduled because of Hurricane Holian as well. So the fact that he's prioritizing this in his last couple of days in office may be a good sign for Europe.
Maybe. Or maybe he just needs to calm them down a little bit. We'll find out a little bit later on when we get the press briefing. What else you need to know this morning? Let's run you through the details. In the UK, regulators are planning to ease bonus rules introduced after the financial crisis. This means that bankers can get some of their bonus cash, immediately and are no longer forced to wait for more than 5 years for full payouts. That duration could be reduced. The concessions come after banks pushed regulators to soften the rules, which are among the strictest globally. The European Union is warning X that it may calculate fines against it by including revenues from Elon Musk's other businesses like SpaceX and Neuralink. The EU has been investigating X for breaching the Digital Services Act, which regulates content moderation on social media platforms. Fines for violating the Act can be as high as 6% of global revenue, so the aggregate number may make a difference there. And Netflix has jumped in late trade after the streaming service added more than 5 million customers in the third quarter and topped expectations across all major financial metrics. Analysts have projected around 4.5 million new subscribers, despite challenges from last year's strikes in Hollywood, which is having an impact on content. Netflix sees growth next year of as much as 13% from a mix of new members and price increases. What is interesting here is they're about to stop publishing subs data. And soon we'll just have to be focusing on the kind of the financial metrics rather than the subs metrics. But also they're pushing really into live sport as well. I read a comment this morning talking about the fact that this increasingly looks like linear television. You've got a kind of streaming service with movies and stuff like that, and then you've got an awful lot of sport that's now coming to Netflix.
However you consume it, I think live TV is great. I mean, others have different...
What's not to love?
What's not to love, exactly, whether it's sport or I don't know, finance news. Kriti, I think it's interesting as well. A lot of people focus for a long time, actually, the last couple of years, on password sharing. Clamp down on password sharing. How long does that keep delivering? Because if it's paid off for them over the last couple of years, that's great. But then that suggests some of the strong performance doesn't continue.
The price increases as well is, I think, the part that caught my eye, not because haven't been trying to do this for a while, but because of where the price increases are being announced. It's in the periphery of Europe, Spain, Italy, getting new price increases, I think, announced as of last week as well, in addition to already seeing some of that growth in the face of price increases in the likes of Japan.
You add it all up, you've got Disney, you've got Netflix. If you subscribe to all of these...
it's a lot of money.
It actually turns out to be quite a lot of money.
You need an audit, a subscription audit. Maybe that's what everybody needs. Right, coming up on the programme, we will head to Brussels as EU leaders have been grappling with both the war in Ukraine and the Middle East. Plus, gold hits a high as interest rate concerns and geopolitical tensions have investors flocking to safety. Up next, the ECB cuts rates as expected. Now what? We'll discuss that after the break. If you have any questions for our guests, please do get involved in our conversations. You can use the function IB plus BBTV Go on your Bloomberg terminal if you want to get in touch with us around this desk and the people who put together this programme. This is Bloomberg.
We believe that the disinflationary process is well on track. And all the information that we received in the last 5 weeks since our last monetary policy decision, we're heading in the same direction, lower. That is what has caused us to make the decision to cut our 3 rates by 25 basis points.
That was, of course, the ECB President, Christine Lagarde, speaking at the press conference yesterday. Disinflation in the Eurozone. What about the rest of Europe? Beata Javorcik, Chief Economist at the EBRD, the European Bank for Reconstruction and Development, joins us now. Javorcik, should I say. I'm terribly sorry. Beata, great to see you this morning. Thank you very much indeed for joining us. So deflation in the Eurozone. What about the regions you cover? What are you seeing? What are the implications of what is happening within the Eurozone for your space?
Well, in the regions where we operate, so in the broadly defined European neighborhood, we also have seen a lot of progress with disinflation. Actually, if you compare what has been happening recently to historical experience, disinflation has been very fast. And it has happened without imposing huge costs in terms of foregone economic growth. However, inflation still remains almost 1.5 points above where it used to be before the pandemic. So the disinflation process is not over. And interest rates in emerging markets where we are active are above the level where they were at the peak inflation. So they are still putting brakes on the economy and central banks are still being quite cautious.
So your advice would be to cut rates, right?
Well, my advice would be to follow ECB in considering all the data, all the available information before making decisions. Because what is happening in some countries is that it seems that inflation expectations are becoming de-anchored, meaning that the share of people surveyed who believe that inflation would be higher in 2025 than it is right now is actually going up. And that's not good news. And that's something that suggests a cautious approach.
Does that conflict with the reality, Beata, of what is actually happening with inflation? I appreciate that's a 2025 forecast. We're not there yet. But that seems interesting. Is that just because people have short memories and they are scarred still by the level of inflation that we've seen?
People have short memories, indeed. If you think about people's experiences, people tend to forget inflation on the order of 10%. If you live through it a decade later, you have no memory of that. However, if you ever lived through a period of hyperinflation, that memory tends to stand with you for life. Now, in many countries where we cover, people who are 50 or older have lived through hyperinflation. So they tend to be more sensitive. Moreover, in Europe, we are facing very high energy prices. Prices of natural gas are 5 times as high as in the US. And that's something that's very salient to people. That's something they grapple with as they see high utility bills.
Something that those people might have lived with or adjacent to, Beata, is war as well. And I wonder what your thoughts are on Ukraine and the prospects for Ukraine as we approach the US election and things could go in various directions from there.
So Early this year, Ukraine was actually growing quite fast. That was thanks to its ability to export grain, metal, and ores through the Black Sea corridor. Then, unfortunately, huge bombings happened, and more than half of Ukrainian power generation infrastructure was destroyed. And that means rolling blackouts. That means some of this electricity is being imported from Europe, but that's more expensive. So that makes life much more difficult for people as well as for businesses. And actually, as the EBRD, we are investing, we are lending to help Ukraine generate, build new generation capacity in a distributed manner so that it will be difficult to bomb.
Eata, let's connect the two topics that we've hit here, which is monetary policy and, of course, the war that what you were just referring to. I'm curious how 2 years out from the war in Ukraine, maybe you think that the ECB is thinking about it in terms of, yes, we see plenty of reconstruction efforts and fiscal spend in going towards Ukraine's direction. But from a monetary perspective, how should Christine Lagarde and her peers be thinking about this?
Well, the war certainly creates uncertainty. And you see this uncertainty when you look at private investment. So private investment in Europe is subdued. You also see it in borrowing cost. When you think about the Eastern European EU member states, when the war started, their cost of borrowing in international markets went up. It went up not only in absolute terms, but also relative to the cost of borrowing faced by Germany. And this extra risk premium is still there. So also the war is having a huge impact on the European economy through energy prices. And that's something that was even mentioned in the latest Draghi report. It's not only prices of natural gas that are 5 times as high in Europe as in the US, it's also electricity price that's 3 times as high. And that's, of course, eroding European competitiveness.
Eata, very quickly, I have to ask about that energy story. How much of it is cushioned 2 years out by excess supply you're getting from around the world? Is that enough to shelter Europe from the impact of that war from an energy lens? Again, 30 seconds.
I think Europe is in a good place. We managed to redirect imports. There are new terminals that have been opened that allow us to import more. We have done a lot in terms of energy efficiency, and in the industry has been able to adjust. But of course, the situation is not rosy.
All right, Eata Javorcik, pleasure to have you on the program, chief economist over at the European Bank for Reconstruction and Development, talking to us a little bit about the connective tissue between the monetary policy, the fiscal policy, and of course, the war in Ukraine. Coming up, we're going to head to Brussels as the European Union leaders grapple with both the war in Ukraine, as we discussed, as well as what's going on in the Middle East. What does that mean for spend? What does that mean for maybe migration, among many, many other issues, of course, as many of the conversations around the budget for Spain, Italy, France are ongoing in Brussels as well. We're going to dive into the details next. Stick with us. This is Bloomberg.
Israel has a right to defend itself, and the threat Hamas poses to Israel must be eliminated. Today, there is clear progress toward that goal. Hamas is decimated, and its leadership is eliminated. This moment gives us an opportunity to finally end the war in Gaza.
U.S. Vice President and Democratic nominee Kamala Harris, they're speaking about the death of Hamas leader Yahya Sinwar. And within hours of his death, fault lines emerged between Israel and Western nations on what comes next in Gaza. Let's get more of Bloomberg's Oliver Crook joining us out of Brussels. Ollie, walk us through the international reaction to Sinwar's death.
Yeah, so remember, this meeting of EU leaders began actually with the GCC EU leader meeting, where you had Mohammed bin Salman and a number of other leaders from across the region who were meeting. And really one of the sort of concrete outcomes of that was, again, a joint call from both the EU and the GCC for a ceasefire in Gaza and in the south of Lebanon. That seemed a sort of very remote option a couple of days ago. It seems a little bit closer now that Israel has achieved at least one of the two aims it would have had to achieve in order to consider its operation successful. And that is the death or capture, in this case the death of Yahya Sinwar. The other is, of course, the release of hostages. And what you're hearing now from European leaders, and I think very similar to what we heard from candidate Harris, is really seeing the opportunity to try to open that discussion, to try to get the release of the hostages and try to de-escalate. We heard from Macron, who was saying that. Starmer making a very similar comments. Baerbock, the German foreign minister, is saying all the same things. And Macron, of course, also going a little bit further and being quite critical of those who are responsible for delivering arms to Israel, which is a not so veiled reference to Biden and the United States. And he'll have the opportunity to deliver that message to Biden himself today when he heads to Berlin for the Quad meeting between Starmer, Scholz, Biden, and Macron. What is interesting there on the question of Israel is you have a sort of two different philosophies there. You have Biden and Scholz on the one hand, who have been very permissive of Prime Minister Benjamin Netanyahu, while Macron and Starmer on the other are a little bit more critical. Can they come together and give a sort of message in this post sort of Sinwar situation for the war? That would be what we'll be watching today out of Berlin.
And so that's what we watch in Berlin. Ollie, we've just wrapped up an EU leaders summit, of course, and the subject of war in Ukraine certainly was on the agenda, and we saw once again Viktor Orban flexing his muscles.
Yeah, that's right. So Viktor Orban making it again more difficult for the G7 plan to proceed about Russian assets, about being frozen and being delivered to Ukraine, really being sort of explicit in the message that basically he's waiting till the outcome of the U.S. election, which is, I think, the frustration for President Zelensky from Ukraine when he was here over the last couple of days, really feeling like there's not a lot that can be done until you have an outcome of the U.S. election. We should say that Biden comes to Berlin with an additional $450 million worth of pledges for Ukraine. That is obviously a positive signal, but I think there was some difficulty for Zelensky to get his message to cut through. The other point, Anna, I think that bears mentioning is this question of migration. This is an intensely sort of intensifying debate here in the European Union. There are a lot of questions about the legality, but this is a sort of European Union that has moved much further to the right in terms of its approach to migration. Poland, for example, really talking about suspending any asylum applications. And this is also connected fundamentally to the war in Ukraine, where they're saying on the Belarusian border, basically the Russians and Belarusians are injecting a volume of people in order to destabilize the situation within Europe. The question is, how do they solve the problem? Italy has gone about sort of sending people to Albania as a sort of third-party place to hold asylum seekers. There's also the question, Anna, of how much this will cost. The Italians saying that it's going to cost about 700 million euros to build those detention centers, so fiscal back and center here in focus for the Europeans.
Oliver, thank you. Bloomberg's Oliver Crook in Brussels. Lots for European leaders to talk about, lots for Biden and Scholz to talk about when they meet. Also happening in Brussels today, we have a NATO meeting taking place, and I'm sure the subject of Ukraine and what's been happening in Gaza and the wider Middle East region will certainly be in focus at that NATO meeting as well. Let's bring things back to markets with all of this geopolitical uncertainty in mind. We're joined by Viktor Hjort, Global Head of Credit and Equity and Derivative Strategy at BNP Paribas Markets 360, with us on set this Friday morning. Victor, nice to see you. So much geopolitical uncertainty, and we're running up to a US election. You make the point in your notes that usually when we head into an election, risk managers tend not to trust risk takers to get politics right, and so we see risk off. We haven't seen that across assets running into this US election. Explain that.
Not at all. And, it's kind of like remember the 5th of November. No one remembers at this point. But it is true that normally, around now, sort of 2-3 weeks before the election, you tend to get that tap on the shoulder. And you see it in positioning data. It goes down into the election. People don't want portfolios or trading desks to have big positions going into this huge binary event. And it is a huge binary event. But that has not at all happened this time around. It's unusual. I think it's a little bit risky, perhaps, because right around now would be when a lot of those decisions normally are happening. And as we discussed earlier, credit spreads are quite tight at the moment, so not a lot of risk cushion.
It's interesting. You call it binary, and I completely understand why that is. But I suppose there are levels of control in Washington that go beyond just who's the president, not downplaying the importance of who is the president. But some people tell us that actually who controls Congress is going to have a material impact on some of the more domestic economic policies. Is that something that you think about when setting up credit strategy, equity strategy for the rest of the year and into next?
I think most likely there will be some kind of split government, and most likely, the influence of the president is somewhat limited. But here you have two candidates that actually have very, very different platforms. You have some proposals that involve very high corporate tax rates, some that involve very, very low corporate tax rates. You have some policies that are very high on tariffs, others that call them unchanged. There is a really, really wide range of policies on the table. And then you look at what the betting markets are saying, and they're saying actually, the probability of a, Republican or Democratic sweep is probably more than 50%. There is all that uncertainty there. Most likely, it may not be a big event, but then there are all these tail scenarios that suggest that you need to be a bit careful.
Yeah. In the last 24 hours, we heard from the New York Federal Reserve, I'm taking this from fiscal policy to monetary policy, that they instituted a new tool that suggests that the markets, the financial reserves in the banking system are almost abundant, I think was the wording that was used. Talk to us a little bit about what that means for quantitative tightening. That data suggests that the Fed can tighten as much as they want. Is there a risk to that?
So quantitative tightening really doesn't get enough attention, and I think it is one of these things when it comes to credit, at least. It definitely influences the amount of money available in credit. But I think the impact is nonlinear, and it is also uncertain. So it's a little bit like Hemingway, gradually, then suddenly. And so I think that the reaction will be at some point the reserves are sufficiently low that it drains up liquidity. Also in the credit market, it's likely to happen in the short end of the fixed income market probably first, like we saw in 2019. But often that spills over very quickly into credit. Really hard to know exactly where that point is, though.
Is there any risk of indigestion when it comes to this market? It feels like that was the conversation, I want to say 6 to 9 months ago, and then it suddenly went in the exact opposite direction. Are there liquidity cracks in credit right now?
No, no real evidence of that. And it also is a little bit a story of how much supply you need to absorb. The market has been absorbing a lot of supply. Corporates have come out and refinanced bonds that they issued back in 2020 during COVID. That has been absorbed very, very well. Going forward, some of that will continue. But you also have much higher rates today than you did several years ago. And so therefore the funding cost is higher, and the sort of willingness of corporates to be aggressive with their balance sheets, lever up and so on, is probably lower than it's been in many years. So there will be some M&A and that stuff coming back. But my guess is that corporates will be a bit more conservative with their balance sheets, and that suggests that they will issue fewer bonds going forward. So easier for the market to absorb.
Spreads are super tight, though. And how much of that, as you mentioned, how much of that is an assumption, is based on an assumption that the Fed is going to keep tightening? And how realistic is that assumption? And is it being tested by the incredibly strong data that we're seeing right now?
I think if there is a tail risk here against those very tight risks, it isn't that the U.S. economy falls into a recession and we didn't see it happen. It is that the data starts turning out too hot again, right? And I guess since the Fed cut 50, both the employment and the inflation data has been coming in above expectations. So they're kind of too hot on both ends of their mandate. The real risk now that there is a very, very firm sense of the Fed put is that it needs to go away. Bloomberg has this nice NLP index of sort of Fed speakers. That is at the most dovish end that it's been since, I think, early 2021. So there's a lot of room for negative surprises if the data actually stays sticky and hot and not softer as the Fed.
So how big a repricing could you potentially see?
Well, if you need to remove the Fed put, you can easily test the wides of the year in credit spreads. That would be a a reasonable downside scenario at the moment.
Wow, so that's quite a long way to go. Just in terms of how you would compare and contrast, though, the situation in Europe versus the United States, it feels like the data here justify potentially the rate cuts that we are seeing. We are not seeing that over in the United States. How different could those markets look in 2025?
Yeah, I mean, the policy and growth mix is way more favorable to U.S. assets at the moment compared to Europe. I think in Europe, the ECB is playing a game of sort of catching up with the economy to the downside, so cutting rates, but cutting rates against the slowing economy. In the U.S., you have a central bank that is proactively taking out insurance against data that is hotter today than it was when they first did the cut. So that balance mix is much more favorable for U.S. assets at the moment, and I guess will continue to be so into 25 as well.
Great to see you. Thanks for stopping by to see us around the table this Friday morning. Viktor Hjort, Global Head of Credit and Equity Derivatives Strategy at BNP Paribas Markets 360. Thank you very much indeed. I want to take you to Brussels. The new NATO Secretary General is speaking. Let's take a listen to what he has to say. Timing in life is everything. And that wasn't good timing. But at least we know that we were watching NATO and the new Secretary General, Mark Rutte, speaking there. Or he was speaking. What else we got?
Well, we also had Lloyd Austin be over there as well. But coming up on the program, we're going to take a break, I think, from what's going on in Europe broadly and take a look at the UK retail sector. Coming up, Boohoo's big miss. We're going to dive into that as part of our Stocks to Watch next. Stick with us. This is Bloomberg.
Welcome back. This is the opening trade this Friday morning, 7:45 in London. So 15 minutes until trading starts for this Friday morning in Europe. And we actually have futures pointing downwards. US equity markets lost steam a little bit towards the end of the session over in the States. And so we maybe have some catch up to do with that particular trade. US futures are flat to positive bit coming from the NASDAQ futures. If you have a look at what's going on in China, though, things anything but flat. We have increasingly some momentum, some positive moves coming through in the China market. There's the CSI 300 up by 4.4% thanks to the PBOC, perhaps, and a little bit the data. Let's talk about this and other things moving markets in 3 minutes with Bloomberg's executive editor for Asia markets, Paul Dobson, who joins us now. Let's start with China then, Paul. We had, yes, data out of China, but then we got the PBOC talking about buybacks and all they're doing in that arena. Is that why we see this surge towards the close on Chinese stocks?
Yes, good morning, Anna. Exactly. When in doubt, get the PBOC to come and comment again. And I think the market really takes a lot of comfort from the comments from Pan Gongsheng, the PBOC chair, who was talking about the take-up that they've already seen and the go-live for some of the initiatives they have to boost the stock market, both in terms of lending out money so that companies can do buybacks and also providing some leverage against other assets for investments into equities. That combination seems to have given the market a renewed sense of confidence today. And so hence we've seen this big rally that's taken us up almost 5% by the end of the day and kind of steamrolled everything. Any concerns there might have been over the data, which was good, but sort of mixed as well, and everything else that came before. So put your trust in Pan, basically.
Paul, if the Chinese equity market goes up, does the Indian equity market go down? Is this a zero-sum game?
I wouldn't say it's exactly that simple, but certainly that is something that we have been seeing through this month. India's stock market is headed for the worst month in a couple of years. There's a few different factors kind of that are playing into that. So not just the relative appeal of China, and we have seen international funds taking some of their money out of India, but also internally there's been a big slug of supply coming through. We've seen IPOs coming into the market, Hyundai's, which was being priced this week, the biggest India's ever seen, received kind of lukewarm demand, and also some of the founder members of big companies are choosing this moment to cash out a little bit, take a little bit of their profits from the companies as well. So there's been a number of factors that are weighing on India's stocks. One other thing is just the amount of the country leans on that market for funding. So over in the credit space, still a relatively small and underdeveloped market. There are some restrictions on how much companies can invest in infrastructure and the like. And so if I may take 5 seconds for a shameless plug for our India Credit Forum coming up in a few hours' time, where we'll be interviewing the central bank governor. You can tune in via Top Live, you can tune in via your terminal, and also on the web to catch up and learn more about what's going on in India's markets.
We love a promo, Paul. Talk to us a little bit then about the read-through into the rest of the world. You mentioned that maybe it isn't a zero-sum game between China and India, but does the China story show up only in commodities for the rest of the world? 30 seconds.
Yeah, I really do think that's the case, Kriti. Still all the way on the way down over the past few years. China seems to be acting almost in isolation. I think part of that is because a bunch of global funds and investors have been hoiking their cash and no longer have the same sort of exposure to China as we've seen previously. So we only really get it through that commodities channel now feeding through. Unless they come back in, that's still going to remain the case.
Bloomberg's executive editor for Asian markets, Paul Dobson, walking us through what we need to know on China this morning and a little bit of India as well. Let's go from the macro to the micro and get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So EssilorLuxottica shares in the US fell last night after the company reported a bit of weakness in their sunglasses business, while their prescription eye care unit remains as strong as ever. It is the brands like Ray-Ban that do seem to be suffering, partly from a sales slowdown in China, but also in Europe and the US as well. As we can see from the screen here, that stock's had a decent run over the past year, up around 30%. So potentially there is going to be a bit of downside in Essilor today. Then in terms of the auto space, we've got a really clear statement from Volvo today, the big truck maker. The company warning that they have seen freight and construction activity coming down in many regions across the world compared with the very high levels that they saw last year. So therefore, potentially, we're going to see weakness in that one, but also in the rivals, including Traton and the other big firm over in Germany, Daimler Truck as well. As we can see, these stocks had a bit of a boost at the beginning of the year alongside other cyclical sectors, have come down a bit since, but potentially, again, another weak one this morning. Then in terms of UK retail, got a bit of breaking news out of Boohoo. They've announced that their CEO is standing down amid another decline in sales, also weaker margins as well for the online clothing retailer. Now, it is a bit of a mid-cap in terms of the size of the company. It's smaller than the rival ASOS, but we can see they had a drop back in August following a profit warning, so it's yet more negative news. But on the other hand, we have gotten this really positive UK retail sales data today with much stronger sales in the last month. These are the retailers to keep an eye on today. As we can see, a bit of a mixed performance. Marks and Spencer's continuing to rally to fresh records, whereas the likes of JD hit by their exposure to the US mostly, but keep an eye on the UK retailers today. Then in terms of your analyst ratings, feeding into the luxury gloom of the week, we've got Richemont cut to neutral over at Goldman, and then Danone over in France gets a downgrade over at Morgan Stanley, but Allianz going the other way, a street high price target over at Berenberg for the insurance and asset manager firm this morning.
Joe, thank you. Our equities reporter, of course, Joe Easton, with an update on some of the stocks that will be in focus. We'll keep our eyes on that. From a macro perspective, we started at the top of the programme. We talked about China. We've done that with Paul a little bit. Real strength coming towards the close in the China market then. We've also seen a bit of movement in the yen on earlier comments by one of their FX voices. Yep. Now we're hearing lines from the BOJ's Ueda continuing to say that financial markets remain unstable, which seems to be a little bit of code, or has been in the past, for we're not hiking in a hurry, because they certainly learnt a lot in August.
What about intervention, though? Maybe that's a fact that we need to bear in mind here. The Volvo story, I think, is fascinating. Joe just mentioning that. The line that stands out from the CEO, Martin Lundstedt, demand for construction equipment has slowed down, especially in Europe. It's really interesting that they are seeing China weakness. They are seeing European weakness as well. They're also pushing back a battery factory. They're not seeing demand for companies basically to move on from kind of the Euro 6 trucks to the next generation of trucks. Interesting. That's a macro signal coming out of Volvo, quite a strong one this morning. Fits into what we heard from Lagarde yesterday.
Yeah, it absolutely does. These macro signals, though, I think are blaring quite aggressively this morning in terms of the Haven assets. And I think that's perhaps where we're going to see it as we await, of course, what Volvo Trucks does at the opening trade. To me, it's the gold story. I think when we were talking about this about an hour ago, gold was seeing a bid. It was hitting those record highs. It's paired some of that move, 27.05 on that precious metal. But the 10-year continues to sell off in the States, 4.11. So the Treasury market isn't getting the same love that perhaps the gold market is.
Yeah, the gold price continues to climb this morning, doesn't it? Up by 0.5%. Silver also by 0.8%. And we have a commodities conversation lined up for the end of the next hour.
Still don't know why. I've been watching this. We've been watching this for months now. Gold has been climbing. Why is it? Is it the dollarization? Is it the risk around the dollar? Other countries are basically saying we want to hold our reserves not in dollars, we want to hold them in gold.
Yeah.
Is it the retail buyer? Is it the China concern story? Is it concern about excess debt?
Is it concern about the US election and just hiding out somewhere?
Precisely. And the risk potentially that Trump takes a more aggressive line on a number of these countries as well. There's risk all over the place. It does seem to be showing up in gold this time. Gold feels like the geopolitical story in the way that oil has in the past, and oil maybe isn't playing that role this time round, which I think is fascinating as well.
It is, and I also feel like with oil, the issue you had was how many of the issues was that this is kind of a macro tourist sector, that the commodity traders aren't driving the oil price, macro traders are instead. I wonder if this is the same idea with gold as well. We're going to dive into that for the rest of the show. Coming up, it is, of course, the opening trades across Europe. Forward futures are pointing lower. It looks like some underperformance right here in the UK. Stick with us. This is Bloomberg.
Happy Friday. A couple of minutes to go until the start of trading. Let's talk about the legacy we get out of the United States yesterday and what it means for Europe this morning. White line here is Europe. We rally kind of towards the close. It's faded a little bit, drift sideways. After that, though, the US market rolls over a little bit. That's maybe potentially why we're seeing the negative futures story, Kriti, that we're seeing in Europe this morning.
Yeah, it's a fascinating one here because it does feel like it's a little bit of a regional story as well. Maybe some heavyweights. Guy, we aren't seeing this across all the indices in Europe. We're only seeing it really concentrated in the FTSE 100, down by 0.6%. Maybe a commodity read through there, as you were mentioning. But then the French market not seeing any love either there, Anna, down about 0.5%. Net, though, bounced out by some of the other markets. Your stock 50 futures are only down 0.2%. We'll see how it shakes out at the open.
Yes, we will. We'll see how China and the read across from the strength in China plays into Europe. We'll see how the strength in the pound this morning, that's today's story, how the strength in the pound plays out for the FTSE. Let's have a look at some individual names then. EssilorLuxottica, the maker of eyeglasses, of course, sales missing, China weakness, part of the story there. There's some better news around Ray-Ban and Meta, if you dig a little deeper. Volvo Trucks, we were talking about this one. Guy, you were mentioning this at the end of the last hour. Slower demand for what are called heavy-duty rigs, and it's interesting that this is across most markets. So we'll watch that and see whether that has any read across into others in the sector or a broader macro read through perhaps. Boohoo in the clothing retail space in the UK, the British fast fashion company, the CEO stepping down, a strategic review underway. The company could then end up being broken up, and it says, the company saying this morning, that it believes that it is really undervalued currently in this market. So we'll watch all of those stocks, how they open this morning. Guy?
Let's talk about the index open. Let's talk about what is happening here Friday morning. What kind of an effect are we going to see from the single stocks? What's the macro going to tell us? The opening trade. Let's take a look at the numbers that we are looking at. We are anticipating maybe some underperformance coming through from the FTSE 100. It's a mechanical process. Better retail sales, stronger pound. That generally means that equities go lower from a translation effect story. And that's maybe what we're seeing at the get-go of trading this morning. But we're not down by that much. There isn't a clear sense of direction, I would argue, maybe from European equities this morning. A little softer. Be interesting to see how the miners, though, trade on the back of what we're seeing out of China this morning. Those markets have been very strong into the Chinese close today. The IBEX is down by 0.3, the DAX is down by 0.2, the CAC is down by 0.2. I would say in aggregate we're a little softer, Kriti, but not by much. What's happening under the hood?
Softer broadly, but the outperformance is exactly what you just pointed out. The China story already showing up at the open in the UK. So the UK is indeed broadly lower, but your best performers, your index contributors to the upside are Glencore, Rio Tinto, Anglo American, BP. Anna, what do those have in common? There are the major commodity names taking their cue from China. The rest of the market, though, not enjoying that same love.
Yes, absolutely. And we saw in the China session, we saw a real surge in Chinese assets towards the close, didn't we? And whether you're looking at Chinese stocks specifically, the Hong Kong market, the Chinese tech market, all of that looking really strong as we head towards the end of the trading day there and the end of the trading week. And it seems, as we were hearing from Paul Dobson, a little bit of a reset from the PBOC, or some extra love from the PBOC being jumped on by investors in China, and some of that flowing through into Europe, as you say, with basic resources going higher. To your point, Guy, we do see some underperformance quite evident now then in the London market as things start to settle down. So there's miners going higher, but other things not necessarily so, and the FTSE 100 down by 0.4%.
It's really hard to read this China story, though, isn't it? Would the Chinese have been better to have done a kind of all-in-one announcement rather than this drip feed? Does the sum of the parts of the single announcements, the kind of smaller announcements, amount to the same thing as a one big announcement?
I wonder if it was planned as an all-in-one, and then they didn't see quite the sustained positivity they hoped for, and then we get this drip feed of extra press conferences.
Yeah, it's a fascinating one. And we talked about how it's showing up in the commodity sector, it's showing up in the others as well. Just take a look at your biggest volume movers this morning showing up on that screen there, showing up in the French market as well. The luxury names that were taking such a beating earlier this week, now actually getting a little bit of love. Process is up there as well. But LVMH, ASML, your heavyweights, which of course are very much China exposed, also driving the upside.
Yes, and that's the Tencent holding in Process, isn't it? Pushing that one higher. So that's up by 3.3% as a result of what we're seeing through the Chinese session. So a direct read across there, and that lifting the AEX.
Let's talk a little bit about what this all means for the Chinese economy, and therefore, by extension, you could argue the European economy. If I listen to Christine Lagarde, the signal doesn't sound so great right now. Let's take a listen to what she had to say yesterday.
Economic activity has been somewhat weaker than expected. While industrial production has been particularly volatile over the summer months, surveys indicate that manufacturing has continued to contract. For services, surveys show an uptick in August, likely supported by a strong summer tourism season, but the latest data point to more sluggish growth.
ECB President Christine Lagarde speaking yesterday at the ECB meeting in Slovenia about the ongoing weak economic activity in the euro area. Let's get a little bit more perspective here. Joining us now is Greg Peters, Co-CIO over at PGIM Fixed Income. Pleasure to have you at the program. Welcome to London.
Thank you.
Talk to us a little bit about the marriage of these two stories. We're talking about weakness in Europe, but perhaps a saving grace coming out of China. Is that enough to maybe hold Europe afloat for a little bit? Does that China stimulus have a read-through here, the way the markets are interpreting this morning?
I don't really think so. I think the China story is very much a China story. So the way we're thinking about it, the way I'm thinking about it is, yes, it does cut off that kind of left tail of China really rolling over hard. But if you look at the policies that are being put forth, and it is somewhat of a drip feed, I think they are trying to figure it out as they go along and respond to, market reactions here. But it's internally focused, right? So growing the Chinese economy is not the way that it once was, right? It's not going to have the draw on commodities. It's not going to have the read-through across the global stage. So I think it's a China story and not a global story.
When we talk about that China story or the read-through or lack thereof, though, we're waiting, I think, from a bond market perspective for it to show up in some way, the way it did back in 2009, into the U.S. market as well. And it doesn't feel like we're getting that, to your point, that's an isolated story. But then what is driving this resilience that we're seeing in the U.S. market and in the translation in the bond market? I'm looking at a 4.11 on the 10-year yield here. In your view, what's going on in treasuries?
I think it's responding to growth. The interesting aspect about what's going on is that it's so volatile. Right? It's so volatile in the face of inflation coming down, pretty stable growth, and central banks moving policy lower. And so I think there's too much data-driven noise in the marketplace. The bond market has swung way too much. You've seen the 2-year note in just a few months traverse 150 basis points. That is a massive move in the face of very little data or change in data. So I think the market, the bond market, is a little schizophrenic. It's reading too much into every single data print. And there's a bias in the marketplace that any news means more rate cuts. And I'm not sure that's really the environment that we're in.
I mean, you talk about, good morning to you, Greg, you talk about little data or no change in the data. Others have highlighted the strength that we've seen, the resilience in the US data. And I mean, that seems to be the new information that the market is responding to. I think that you think that yields are going to be stable or lower from here. How do you fit that with the resilience that we're seeing in some of the US data?
So the way we're looking at it is that we are in a pretty stable growth environment, and inflation is just around the same level. So if you kind of put those two factors together, that equates to less policy shifts lower, number one. And number two, that should augur yields being kind of stable to higher. The reason why the bond market rallied so much across the curve was not the change in growth. It was the change in pricing of the front end, which was, as I mentioned, a little too schizophrenic. So as soon as that starts to come off the boil, then I think yields will kind of settle in.
Greg, if we take a step back from where we are sort of day to day in Treasury markets, and we came from a period that some people called secular stagnation, then we saw these generational highs in inflation, really strong inflation impulses in the US and elsewhere. Where are we heading now? What is this period going to be?
I think we're in a very different regime. The post-GFC world is over. The data read, as we mentioned, is really hard to suss out and truly understand. But there's more inflation in the system today. There's productivity gains, seemingly, and response to technology, which is why you're seeing the U.S. equity market do so well. So I think we're in a different world. And that different world means rates are higher, not lower. And I don't think that narrative has truly been absorbed yet. And I think that's what will occur over the course of the next several quarters and several years.
What range do you think the US 10-year is going to trade in next year?
A wide range, which I hate as a bond investor. You want to get a little more narrow, but I think we're in a range of 3 to 5%. I think it's but it's really contingent on what happens on the policy side. But what's not really being talked about enough is the deficit, right? And so that will be a continued kind of problem.
And that requires a higher term premium.
It does.
By how much?
Well, more. So, I won't get into kind of the math of it all.
Getting into the specifics here.
But more, right? So it's just, right, at its core, supply and demand, right? So the U.S. Treasury has to fund their debt. There's more supply coming, and that increases the term premium, risk premium, and so that all else equal should equate to higher yields, not lower yields. But if you look at the policies in place, that's also more inflationary, not disinflationary. You hear all the stories about supply chains moving, onshoring, nearshoring, friendshoring. That puts friction in the system. That's inflationary, not disinflationary.
How do you trade the deficit at the moment? January 20th, we get a new president. January 10th, we hit the debt ceiling. How do you trade it?
I think you trade it through the curve. I think the way it manifests itself is, once again, going back to the risk term premium, the shape of the U.S. Treasury curve. Trading deficits is really tricky because it doesn't matter until it matters, right? And so no one really knows that tipping point. It just seems to occur. But I think the way it manifests itself is through inflation and steeper curves.
Does it ever matter in the U.S.?
Well, I think the U.S. has a luxury position in that it's a reserve currency. But those things change. We're sitting here in London. There was a point in time where the pound was, the same. So you have to be careful. But I do think the U.S. is in a much better position. But what the U.S. has going for it, other than the U.K., is deficits are rising everywhere. So we're kind of hiding behind everywhere else in the world, which actually makes it more problematic, not less.
Sort of safety in numbers.
Talking of numbers, do I sell treasuries if Trump wins the presidency?
I think the tendency will be for yields to go higher, not lower.
So yes.
You can interpret that.
Prices might go down.
But there's a lot to flow through, right? So it depends on what Congress looks like. But the point is, no matter who is president, no matter what the makeup of the House and Senate looks like, deficits are not moving lower.
No.
And that's the story.
You said a range of 3 to 5% in 2025. There is some commentary out there that 6% is on the table. Do you buy it?
It's possible, but what has to happen in that environment is inflation has to move much, much higher. I just don't really kind of see
Where could that come from, though? Where could that risk of higher inflation come from? Is this a wages story, a tariff story? Where does it come from?
Well, so the tariffs is a one-shot kind of inflation hit. Wages are key, of course. But if you have that situation where inflation moves higher due to higher wages, that means it's a very strong job market. That means growth is very good. And so 6% is actually probably a good story, not a bad story. The other way you get there is if there's confidence lost in the U.S. system, and that's a whole different narrative.
It's great to see you.
Thank you.
It's going to be an interesting election. It's going to be an interesting 2025 by the sounds of things as well. Greg, thank you very much. Greg Peters, Co-CIO at PGIM Fixed Income. Thank you very much indeed. Let's take a look at what the Core 6 looks like this morning and show you what is going on across Europe in terms of the more important stocks that we watch very carefully. Schneider's a little softer this morning, which I think is interesting. Yesterday we were focused on that. ASML bouncing quite strongly as well. We've got some interesting conversations coming up with LVMH. Luxury is up too. That maybe is the China read across. It is interesting to see that those stocks there are bouncing back. Maybe a bit of money coming out of the pharmaceutical sector. Sort of focus on Ferrari for a moment, which is in the green today. But yesterday we saw the... you guys are going to be fascinated by this. Just give me
I already am.
Yep. The F80 gets released. New supercar out of... This is the picture of it. These are the pictures of it. It's kind of... It's part of a Le Mans car. It's part of an F1 car. It's part of a road car. They don't produce many hypercars very often. So once every 10 years, the last one was La Ferrari, they produce a new hypercar. They know where they're going to sell them to. It's a really big deal for Ferrari.
Yes. What other colours does it come in? That's what I want to know.
Are any other colours appropriate, I wonder? I mean, I was looking at the price tag on this. 3 million, I mean, that's in pounds. 3 million pounds, I think, one of these will cost you. It's interesting, it comes on the day where we had that news about banker bonuses in the UK. So, if you're trying to find something to spend the money on, then maybe this. And if it all goes wrong, costs 3 million, maybe you could live in it.
So,
it's the price of a very, very large house.
It may not be that comfortable, but it goes very, very fast. And I suspect it's going to be one of those kind of stories that maybe holds its value. Maybe you could see this as an investment. These things, there are so few of them produced, I think just shy of 400, that demand is always going to be there in the resale market. Basically, you have to be a really good Ferrari customer to be offered the chance of buying one of these. It's a bit like a Hermes handbag.
This is like a Birkin for boys.
That's exactly what it is, only in red. Yep. Let's check out what's happening at the individual stock level. Joe Easton has his eyes on all of those stock moves for us. Joe.
So we are seeing some weakness in Essilor today. Remember, the sunglasses and prescription eye care company did report a bit of weakness in the Ray-Bans and other brands last night. So that one coming down around 2% at the moment. But going the other way is Brunello Cucinelli. This is in luxury. It's been a bad week for luxury, but analysts saying Brunello's results just pretty much bang in line with what they were looking for. So therefore, a bit of a relief for the maker of fancy cashmere sweaters over in Italy today. But then the retail space not looking great is Boohoo. That one has actually slightly recovered since the open. It was down 9% at the open. They've announced that their CEO is standing down. They've seen a decline in sales. Margins looking pretty weak as well. We did get that UK retail data, but not seeing a huge reaction. Potentially analysts had a kind of a view on that already, so probably knew that was coming. So we're seeing pretty steady movements in there despite that gain we saw for the pound today. Then in terms of another sector, it is the trucks. Weakness in Volvo cars. Remember in their statement, warning of a slowdown in construction specifically. So a lot of construction vehicles not selling as well. But actually, the other peers holding up okay at the moment. Daimler Truck and Traton actually both stronger in Germany, but Volvo coming down over in Stockholm this morning. Then in terms of another one I wanted to bring you, this one is actually just broken on the terminal. British American Tobacco announcing that they have neared a settlement in Canada on litigation around the healthcare effects of smoking. It's something that's been going on for around 2 decades for BAT. They're saying they're nearing settling that, but that would mean potentially cash coming out for the moment, but later, according to analysts, that might actually be a positive thing for them. Then in terms of the ratings, Goldman has had a buy on Richemont for around 5 years, but they have cut it finally to neutral, given the warnings that we've seen from that sector today. They're not at sell yet, but they have come down, no longer recommending buying that on. And then in the industrial space, also in Switzerland, Schindler, this one is raised to neutral at Boffa. This is the maker of all those escalators that you see. They are citing a better performance in the residential and non-residential real estate market, potentially boosting Schindler, but not seeing too much of movement. It's down 0.2% in Switzerland this morning.
Thanks very much, Joe Easton, with a briefing on those movers this morning. We'll continue our focus on individual stocks. After the break coming up, Netflix is in focus, smashing expectations, delivering a blockbuster set of earnings. We will have all the details on sustainability here, could be part of the conversation. This is Bloomberg.
20 minutes into the equity market session here this Friday, and I'm telling you there is a definite China effect in European equities this morning. You've got a whole load of luxury names doing quite well. Burberry's up, Kering's up, Boss is up. You've got Moncler doing well as well. So the luxury names are having a good day. If you take a look at the sector story, where we are seeing strength this morning is in the basic resources. The mining names in particular stand out this morning as we see potentially more help coming through for the Chinese economy, rippling into the housing story. That is a potential positive for the mining names as well. So it's good. The industrial production data out of China as well look fairly favourable too. You would have thought that would speak to the miners as well.
Yeah, and I know some of the write-ups I was reading this morning suggested that the data was mixed, but most of it came in better than estimates, didn't it? Whether that was GDP, industrial output, or retail sales. Admittedly, the estimates, were probably people had low expectation, and this is very backward-looking. It's before we get the effect of any of the stimulus that we might see ahead of us. I suppose the GDP number did slow from the quarter before, and that was the thing that seemed to weigh on sentiment a little bit.
Well, to me, I think what's interesting is that we talked about kind of the connective tissue here. It's very clear in commodities, right? You have the stimulus in terms of the property sector, et cetera. Where is the stimulus, and how does it connect to the luxury sector? Because in France, that's where you're seeing the read-through this morning. And yet, that's not as clear to me, because whatever happens in the property sector or the market has to help the Chinese consumer and then Europe.
Okay, retail sales around the world look good right now. Okay? Out of the States, look pretty favourable. The retail sales data out of China this morning has beaten expectations as well. You take it the retail sales number out of the UK, a small market, but let's factor it into our thinking as well. All of these numbers look fairly good. So China is, but China's been the area that these guys have been flagging.
Yes, and you were looking at watch prices, and I was just looking at a story from our colleague Andy Hoffman just yesterday. Swiss watch exports fell really quite sharply in September, and that was all to do with shipments to China, dropping by half. That's that's the weakness. That's what we're seeing. And Greg Peters was talking to us about this being quite a sort of contained China for China story, but clearly, I mean, equity markets trying to make those connective links.
Yeah, it's a. I don't even know where to go with this, because it does feel like a little bit of a head fake. We've been here before where the markets have reacted, and then it's a question of sustainability, and I don't know if this is that moment.
The struggle I think a lot of people are having is putting it all together. How easy is it to create a unified picture of exactly what the Chinese are doing? They're clearly trying to do something. Is it enough? Can you figure out what the various policy announcements that we've seen actually add up to at this point? I think that's the real struggle at the moment. And I think that's where a lot of people are finding it hard. It seems like we are day trading this story rather than seeing it as anything strategic.
Yeah, it's a fascinating one. Again, let's see how much of that sticks amid a broaderly weaker market. It's that China read-through. That's the only one that's kind of vaguely in the green. Let's talk about another story that we have been keeping our eye on in the last 24 hours. Netflix jumped in late trade over in the U.S. after the streaming service added more than 5 million customers in the third quarter, topping expectations across all major financial metrics. Now, analysts had projected about 4.5 million new subscriptions, despite challenges from last year's strikes in Hollywood. Now, Netflix sees growth next year of as much as 13% from a mix of new members and price increases. Netflix Co-CIO Ted Sarandos weighing in on the outlook.
Let's start with, looking into 2025, we're feeling really good about the business. We had a plan to reaccelerate growth, and we delivered on that plan. You can see that in our 2024 financials. We expect to deliver 15% revenue growth and 6 percentage points of operating margin improvement. And engagement, which we view as our best proxy for member happiness, because when people watch more, they stick around longer. So that's retention.
Let's bring in Bloomberg's Charlie Wells, an avid Netflix watcher, I'm sure.
And Netflix and chill,
what I really want to know is what you watch on Netflix and what you have watched. But instead, let's talk about how Netflix compared to Wall Street, how are they still doing so well?
So this really comes down to some tried and true tricks that they've had up their sleeve for a while now. So that is that great Netflix password crackdown, which I know annoyed a lot of consumers, but it brought in a lot of new subscribers. Since they implemented that policy, they've brought in 60 million new subscribers. And we throw around these numbers all the time, but 60 million, that is the size of Italy's population. So since 2022, they've added 60 million people. That's a lot. They've also rolled out that ad-supported tier, and I think that's been helpful because for those people who are maybe, using mom or dad's subscription, they have been able to get that lower price option. So they have been bringing in a lot of people, an Italy-sized population since that time, and that has really supported their share price, right? Up 300%, over 300% since May 2022.
Okay. Outrageous using the parents' password. Where does Netflix predict the growth coming from then, Charlie? Because you've talked about a couple of trends there, and maybe the lower price option continues to be something consumers like, but you can't clamp down on password sharing forever.
Yeah, exactly. You kind of squeeze them out, and you can't keep squeezing. Management has tried to say that they will be able to keep squeezing, but what we heard in that soundbite earlier was about engagement, and that's a metric that Netflix really wants to focus on. In their earnings call, they talked about how the average user, this is not me, this is the average user, spends 2 hours per day watching Netflix. Like, that's a lot. I don't think any of us has 2 hours a day to spend watching Netflix, but they think that is a healthy metric. And the other thing that they really have been hammering home recently...
A healthy metric for them.
Yes, exactly, for them, maybe not for us, is content. And so they keep talking about how in the pipeline they've got the new Squid Game, they've got NFL games on Christmas. And so if you have this content, if you have a reason for watching,
they're beginning to feel like networks. Which is really interesting. There's a story in the Journal this morning. It's not about Netflix, but it's about Brian Williams is going to host a live election night special on Amazon Prime Video. It's a one-night special, streaming's first foray into live news programming. You've got, as you just mentioned, the NFL games on Christmas Day on Netflix. This is becoming a linear TV product.
It's like what's old is new and what's new is old, and you kind of had that like...
There's nothing new in television. I've definitely...
I believe that. And you get this like disintermediation, then it comes back. And I think, again, they have some of the issues that networks have is, advertising, right? They've got to get advertising right. Management was talking about how they need more time. This is something that's been expensive for them. They've got to kind of roll out that ad tech, and they need, which we do here in linear television, inventory. And that's kind of where sports come in. The other thing that I think we should talk about is pricing, right? Because Netflix has kind of become the value option for a lot of people.
Really?
Yeah, they've got that higher tier, but they've got that ad-supported tier.
Yep.
But can they increase prices? I think it comes back to content then. Do you have the stuff that people want to watch? Are they willing to pay for it?
Good to see Charlie. We're going to find out what Charlie watches in the break. That's coming up in just a moment. Maybe we'll reveal the secret. Anyway, up next, we're going to talk about UK business. Ahead of the budget, we need to take its temperature. We'll do that next. This is Bloomberg.
Welcome back. Friday morning. This is the opening trade. 30 minutes into a session that has turned a little more positive than where it was when we started. We had seen a lot of pressure on some of these markets. The FTSE 100 is still under pressure, down by 0.3%. But elsewhere, we see modest gains. Pretty flat, though, overall. Let's turn our attention to the UK economy and one measure of it. Business activity among UK small and medium-sized enterprises cooled in September, whilst employment remained strong. This is all according to the findings of a NatWest survey. UK SMEs reported optimism for year-ahead growth, but the overall degree of business confidence slipped to a 10-month low, with some citing concerns ahead of the autumn budget due on October 30th, of course. Let's bring in James Holian, who is head of business banking at NatWest, here on set this Friday. James, good morning to you.
Good morning to you.
It fell marginally, this reading of business activity among SMEs, into contraction territory, actually, but it seems as if the wider story, there are some reasons to be a little more cheerful?
I think there's definitely reasons to be cheerful. It's a mixed set of results, almost like the morning markets that you were talking about a minute ago. Confidence and sentiment often drops at this time of year as well. So it's quite consistent, actually, with last year at this time.
Yeah, and I wonder, for this particular cohort, how stimulating is it to have rates coming down? Because a lot of people talk about, we're going to stimulate the UK economy because rates can come down, and that's the way that things should work. But if these businesses don't have a lot of debt, do they feel that that kind of vibe?
I think that's one of the things that is interesting about small businesses. There's quite a lot of them that are actually very cash rich. So for the last few years, and higher rates has actually been quite positive for them as they've been able to earn interest on their savings. For those that do need to borrow, obviously lower rates would help. But the rate cuts we're looking at over the coming months aren't particularly massive in terms of small businesses.
That's a really interesting dynamic, the way that UK rates work and how higher rates can actually be stimulating because of the interest you earn on them.
Well, that's been one of the problems that we've been watching for.
The transmission.
The transmission has been slowed because a lot of people locked in lower rates and also potentially those that are cash rich and maybe older generations are benefiting from that. It's interesting that small businesses are doing the same thing. Are they worried about the budget?
I think, again, it's a bit like the overall story. Some of them are worried, some of them are less worried.
Why are they worried? Why are those that are worried?
I think there's the $64,000 question or the £40 billion question, as you might term it right now. And I think the government's being very careful. The government has certainly come in and been very pro-business in their rhetoric. But small businesses are worried, right? You'll see in our report, construction's doing quite well. Services industries have had it more difficult. If you look at restaurants and things like that, I think we're all aware that they have had a difficult time of late.
How specific did you get into this? Is it concerns around, for instance, NI and pensions and capital gains tax? Where is it specifically that there is concern?
It's not specific about any of those things. Most small businesses really are focused on running their businesses day to day rather than the upcoming budget. But if you have had a tough time in recent years and you are more fragile, of course, as a small business owner, you'll be worried about it.
Just to follow up, do you think small businesses and the people that run them would be deterred from starting small businesses were capital gains to be higher?
No.
Good answer.
Talk to us a little bit more about the fiscal side here. How do you subsidize some of the small and mid-sized business activity when you're seeing a lot of that happen, for example, in the States?
Sorry, how do we subsidise?
Yeah, or how do you help them? How do you incentivize them?
How's the government
from
help
a fiscal
them?
perspective?
Yeah, I guess so. There's quite a lot of focus around long-term and increasing our focus on investment and long-term in the UK. In the US, I think the government and business has been better at focusing long-term, as well as in Germany and things like that. And we've probably had too much of a short-termist mindset in the UK. As we look forward as a country, I think there's probably three things that we really need. First, we need a sort of thoughtful approach to managing the economy. Right, that's really important. Some of the changes that are being discussed right now might have unintended consequences, and thinking through what those things are really needs to be thought about. Secondly, as I said, being long-term. And then third, being predictable, right? Small businesses like a stable and predictable environment. We haven't had that in recent years with COVID, with Ukraine, with energy prices, with Brexit and all of those things. And right now it actually feels more stable now, both for now and in the as we look ahead.
The Prime Minister's talked a lot about regulation and the need to maybe push back and push down regulation to make the regulatory burden less onerous. Is that something that small businesses complain about as well?
It's definitely an issue for smaller businesses. Regulation is typically harder for small businesses to deal with than larger businesses. And when we're talking to them, right, they are concerned about new regulation because they're just not of the size with professional HR or finance departments.
Does the new employment laws make it harder, easier to hire? It does seem as if they're hiring at the moment. Actually,
they're hiring at the moment.
Looks good.
They're hiring at the moment. We've seen more hiring. The Employment Rights Bill is being talked about at the moment for launch in kind of 2026. So there's good time for the government to get that right. Government is clearly trying to do that for the benefit of employees, but government also recognises the importance of business creating jobs and those things. So I think government will be appropriately balanced on those things.
All right. James Holian, Head of Business Banking over at NatWest. We thank you so much for joining the program, telling us a little bit about what those SMEs actually look like. It's a fascinating question as well because there's so many interdynamics that we are seeing within the city and, of course, how the broader fiscal policy and monetary policy affects a lot of that. Let's go straight to that conversation. Black workers and diversity practitioners in the City of London have told Bloomberg that corporate priorities are shifting away from diversity. The UK's financial services sector had pledged to boost representation in the wake of George Floyd's death. But 4 years later, progress remains uncertain. Bloomberg's Eata joins us for more after months of investigating this story. Tiwa, talk to us a little bit about this. We've seen a pushback against DEI in the States. It's happening right here in the UK?
So in the States, we see that the pressure is really coming from the regulatory and legal side. That's not happening in the UK. In fact, the change is being driven by firms themselves. So they're reducing their spending on DEI initiatives. They're reducing their spending with groups that work to bring diverse and black talent into the city. I actually spoke to one of them, the Taylor Bennett Foundation, which operates across the communications landscape, but they work with the likes of HSBC and Santander, and they told me that spending on their paid internship programs is actually down 25% since 2022. And that's despite seeing quite a big uptick in interest in 2020 after the murder of George Floyd. So we are seeing a bit of pullback from firms in this space.
Yeah, and Tiwa, tell us a little more about what is behind this, because you've contrasted a little the drivers between the US and the UK.
So I spoke to someone who put it quite succinctly to me, and they said that there's a perfect storm at the moment, and that's because there are economic headwinds, there's a tense political climate around DEI, driven slightly by what's happening in the States, and because of that rush to bring in change that we saw in 2020, a lot of firms aren't seeing the sort of results that they need to justify that investment. And so they're sort of reassessing with squeezed budgets, and they're thinking perhaps we need to pull back here, perhaps we need to reassess and see how we can further drive change.
OK, so what does this actually mean in practical terms? What does it mean for black workers?
So I spoke to a number of black workers across the City of London, from private equity to investment banking. And what they're telling me is that it's really impacting their day-to-day life. So they're noticing subtle changes. So that could be a reduction in the number of Black History Month events, a reduction in networking events for people of colour. And that's impacting them, and we can see it actually reflected in the data, because black people are leaving the city before they reach its top rank. So, for example, in UK law firms, black people are 4 times more likely to leave than their counterparts. And if you look at the top levels of, say, investment banking, for example, in the UK, the representation for black people is just 0.5%. And we can see that maintained across ethnicity pay gap data as well. There is a big gap, particularly for black workers, and that suggests to us that there is a concentration of black talent at a junior level. So the real impact that we're seeing is quite high attrition and black people leaving the city because they don't feel supported.
Tiwa, we're going to leave it there. Fantastic reporting. Thank you very much indeed for bringing it to us, Tiwa Adebayo. Let's talk about what we are watching in Germany right now. I want to take you there. We have a live shot coming from the Bellevue Palace. We are anticipating the imminent arrival of President Biden. He will meet the German President, Frank-Walter Steinmeier, very, very shortly. Nice day in Berlin. We'll see what comes out of this a little bit later on. We're anticipating a press conference, and we'll bring you the details of that later on in programming. Let's turn to talk about what we're going to be having next on the programme. We're going to be talking about what is happening in the commodity space. Gold is a fascinating subject right now, as is the energy market. Nadia Wiggen from Svelland Capital is going to be joining us next. We'll talk about that gold story. That's the first question, but I would talk about gas as well. That's going to have an interesting impact in Europe this winter. All of that coming up. This is Bloomberg. Welcome back. You're watching the opening trade. We are 42 minutes into the equity market session, broadly positive. We've turned around a little bit, so a more positive sentiment beginning to pervade the story here. You're seeing luxury doing fairly well, and you are seeing the mining story doing very well as well. All of this off the back of what we're seeing in China. We'll come back to the China story in just a moment. I want to talk about the geopolitical element to all of this as well. Israel says it will continue fighting the war in Gaza even after the death of the Hamas leader, Yahya Sinwar. The US President Joe Biden has said that his death presents an opportunity to end the war in Gaza, though. But the Israeli Prime Minister Benjamin Netanyahu has vowed to keep fighting until all hostages have been freed. Oil prices very much in focus on the back of what we're seeing here. We're watching the Middle East and the story. We're also watching what is happening in China as well. Let's talk a little bit about what the commodities picture looks like in totality. Nadia Wiggen, who's director of Svelland Capital, sitting around the table with us this morning. Nice to see you.
Good morning. Thank you.
Not much movement around the oil price around what is happening with geopolitics right now. Is that a surprise?
Well, the markets accepted that Israel's not going to go after either Iranian nuclear capabilities or after the oil complex, at least until the election. So we have almost 3 weeks.
OK. So given that we've got a little bit of a hiatus until we see maybe that being factored back in, what is driving the story? I'm looking at China looking relatively strong. We've got a stimulus story that is coming through, albeit in a piecemeal fashion. The US data looks super strong right now. Why aren't we seeing some of that more positive economic news potentially being priced in?
Well, the China stimulus will really affect oil demand next year, in our view. When we look at inventories, yes, they drew in the U.S. That was a positive. But it was a little bit of a surprise given that imports were so low. When we look at the physical market, we have all these Libyan barrels that have come back into the market, and they're very prompt and they're available cheaply. So the market needs to absorb that additional supply. And so that physical picture isn't as supportive as that paper picture on the geopolitical side.
Nadia, talking about the effect of China next year, does that mean you quite like what you hear out of China and you think that it is material and it's going to make a real difference? Because sort of day in, day out, it seems difficult to assess.
Absolutely. When we look on the actual retail level, it helps individuals around $300 a month in terms of spending purchasing power. When we look at which part of commodities will be most supportive, we see that on the metal side. We also see a lot of activity coming forward in terms of energy transition, grid spend, and so forth. So we think it's actually more supportive towards iron ore and copper and LNG. And then eventually that will trickle down into oil next year.
Is that because it helps the property sector and we see more construction, or people spend more money on cars and they use metals? I mean, what's the sort of linkage?
I think on the property side is more that we're looking at bottoming out. We haven't really seen growth. Spending on cars is definitely suffering. $300 a month we don't think is going to be spent on cars. More likely to be spent on savings, also on gold and on some purchasing. But we really want to see that impetus in terms of that consumer coming into the market. When it's the renewable side, it's more government spending and infrastructure.
I want to circle back to where Guy started, which is kind of a little bit of the geopolitics here. Is there a complacency in this market when it comes to whether it's gold or whether it's oil reacting to developments either out of the Middle East or in the war in Ukraine? Is that even a factor the way it was, say, 2 years ago?
It's less of a factor than it was because the market's become more numb. The latest developments in terms of escalation has kept a longer war premium than, let's say, we saw in April in terms of the immediate effect. But of course, we came from a very short market. Net length was short in oil. And that is because of this concern in the near term about an oversupply and whether OPEC will stay together and actually maintain production discipline and cuts through next year. When we look at the war with Ukraine, I mean, what we saw yesterday is additional sanctioning of tankers and some LNG vessels on Russia. So there's a question if the U.S. will continue to make things and the G7 more difficult for Russian exports. But that immediate impact will be more on the actual shipping sector, so on the tanker market, on the LNG markets, rather than on the oil or natural gas balances, because we have the demand. So the commodities will have to get out.
In aggregate, is there a danger that Europe is undersupplied this winter when it comes to gas? So we perceive China's stimulus as being positive for Europe because we see extra demand coming through. But actually, if the Chinese economy starts to pick up the pace, then gas demand is going to increase. They're also converting, as you say, trucks potentially to running on that gas as well. That increases the demand as well. Europe is going to need quite a lot of supply this winter. If China's competing for it aggressively, what does that mean for Europe?
Well, it means that it will be a fight to pull in barrels. And we have to remember that storage is around 95% full.
Yeah.
But at 100%, that only fills 25% of European demand. The reason why the gas price has been as stable as it has been is because we have records amount of hydro available. It's the opposite of 2022 when we had a drought across the northern hemisphere. And we also have more renewables capacity, but we can't guarantee how much wind is going to blow throughout the winter.
So we get a cold winter. What do you think gas prices, how much higher could they potentially be?
It's always difficult to say how acute it is, what happens in the Middle East, if Qatar is not delivering. But, 10% upside easily. And that is something, when we look at positioning, it's not bullish right now among speculators in natural gas. So that creates a lot of upside going forward. But I mean, we've had in 2022 enormous growth. So what is 10% versus hundreds?
Well, back in 2022, there was also a question of that there's no infrastructure to import some of this stuff, specifically from the United States. The exports coming out of Louisiana, for example, or Florida, there was no place to come at it. 2 years later, I think you hit on this, that there are terminals now in Greece and in other places. Talk to us about that export dynamic, especially in the context of the U.S. election.
Well, this is where when the Biden administration put that temporary halt on things in LNG, that put a lot of fear into Europe because that is meant to be our long-term partner. Qatar came in there and said, oh, we will be the long-term provider. In the meantime, though, we are supposed to have LNG terminal trains come online in Q4, and they've been delayed. Q4 this year to Q4 next year. So it is actually a tighter supply picture in terms of what is coming out. We constantly get outages in the U.S., in terms of exports, and we could still have another hurricane, which we don't know how that could affect things.
But you mentioned that key piece, which is that Biden had created that lock on that federal export piece, and that did show up in the markets. Now that he is not going to be the next president, is that risk eliminated, given that Kamala Harris and President Trump, former President Donald Trump, have very different approaches to the energy story than Joe Biden did?
Yes. In our view, it's very important that security is prioritized. And so we expect that both will allow LNG permitting to continue. In our view, that was more of a tactical move by the Biden administration to support industry within America that wants as cheap natural gas prices as possible as an input. But really, in the medium term, it's far more important to have that relationship as a serious gas exporter so that Europe and the rest of the world does not become more dependent on Russia, the BRICS countries, the Middle East and so forth.
Nadia, what's happening with gold exactly? It seems that the gold price, I mean, we've touched new highs just in the last 24 hours, keeps on rising. We were throwing around this idea of, what exactly is driving gold higher. It seems to be immune to all the conversations about pairing Fed rate cut bets as well, which is sort of day-to-day kind of interesting. So what's the longer-term momentum? Is it a haven? And if so, is it from geopolitics in the Middle East or US politics?
So I would say it's a combination of all those things. The main buyer consistently this year has been governments. And this is when we look at the geopolitical situation, the U.S. likes to, sanction through the U.S. dollar. And this, when we look at Russia, 26% of foreign reserves are held in gold. If we look at China, only 4.3% are. So if China wants to go more the Russia route and be more immune and be able to more easily purchase Russian commodities, there is a lot of buying to still come going forward. And there's a major BRICS meeting next week in Russia that's taking place. And Saudi Arabia looks like won't be joining, but still you have Iran there. You have a big expansion. So this is, I think, in terms of diversification, a huge driver. But on the ETF side, that's where, the U.S. came into that market as a net buyer in July. And we've seen globally net buying come in since April. And, in May, that's when we hit that first all-time high. And we've just been going higher and higher since.
So how does the US election play in? I mean, if we see another Trump presidency, a lot of people say that would be inflationary. So that's one side of things. But it also might increase geopolitical tension, which plays into some of the themes that have been driving gold higher.
Both camps are into fiscal spending. So probably both will be inflationary in our view. But Trump has specifically said that he will go after countries that try to go off the U.S. dollar. So that will be quite interesting. And this is where I think the communication out of this BRICS conference will be very careful. And we'll have to see over time how things change. What we've seen recently, actually, is it's been a step away from the euro, not really the dollar in terms of the changes of flows.
OK, Nadia, thank you so much. Nadia Martin-Wiggen joining us from Svelland Capital, setting us up for that BRICS meeting. Really interesting. It does seem the Chinese will be in attendance at that. So certainly something we will continue to watch. And speaking of China, we've seen real strength in Chinese assets, haven't we, coming towards the close? Well, when we were running up to the close, things really strengthened over in the Chinese market. We saw the Shanghai Composite, the CSI 300, measures of tech stocks and tech strength, the Hang Seng, all of that doing really well. And then that pushes through into luxury names, perhaps here in Europe. Let's have a quick look at where we are on the luxury story. We can see some positive moves coming through on some of those luxury stocks this morning, some up more than 3%.
It's interesting. You've got a fairly nuanced picture emerging in the commodity space. Just been talking to Nadia about that. Aluminium, copper, higher, but you've actually got iron ore a little softer this morning, which I think is interesting in the light of what we've heard from the Chinese. Crude, absolutely flat. Very little movement there. In terms of the way it's translating through into some of the mining stocks, as you can see, quite a lot of green on the screen when it comes to the luxury names. I'm sure at some moment we're going to see what's happening with the mining stocks as well. And there you go. A positive picture there as well.
Positive picture there as well. Let's look ahead to what we're going to get next week, because it is, of course, Friday, and there are a few programming notes to be making. ECB President Christine Lagarde sitting down with our very own Francine Lockwood. That coming up at Tuesday at 3 p.m. UK time. It's a conversation you will not want to miss. Plus, the ASML CEO as part of the Bloomberg Tech Conference also on Tuesday. Catch that at 9 a.m. UK time. Fascinating conversation at a time of a lot of geopolitical tensions. But before we go into all of that, we've got the weekend.
We do. That's the most important thing. It's
Yes.
Friday. TGIF. What have we got coming up this weekend? The film festival continues here in London. Dutch Design Week, I am told. That feels like an Anna Edwards edition.
Do you know, I went on... Don't go on the website if you're feeling fragile, because it's extremely bright this Friday morning. Almost blinding. But very exciting.
I'm looking forward to that. The head of the Charles Regatta, so that's a rowing race.
Can you tell that there's a very keen rower on our team?
Yes.
Yeah,
he's
sort of
added that one in.
subtly slipping in these rowing references.
I'm going to put the sailing in as well. It's 4-2 in the America's Cup. 2 races this afternoon. We want it to be choppy. We want Britannia to do well. We need the weather to be a little bit more blustery off the coast of Spain. And the football's back. The Premier League is returning. It's a busy weekend coming up. You're going walking, though.
I'm going.
Critty's going for a yomp this weekend.
There's a debate of whether it's a walk or a hike, and we don't fully know. But we're going to find out, and we'll report back on Monday.
The royal we.
We, as in like me and my friends.
Critty weirdly loses her voice when she goes walking. I'm not.
It is. So we'll know how it goes.
How tough it was.
If it's a hike, I might lose my voice. If it's a walk, it might get a little louder. We don't know.
So The Apprentice, the film The Apprentice, is out as well. Did we mention that as we were looking at the things that are going on
Donald
at the
Trump
weekend?
connection here as well?
Yes, I know. I find it interesting. It's fascinating, isn't it? Talking about broadcasting, no impartiality rules, I suppose, in cinemas, in movie theatres, ahead of elections, in the same way that there are in news channels. But there you go, looking at some images of that.
Okay,
that takes us to the end of the program.
I was just trying to work out.
Speechless.
How do you follow that?
I haven't seen the trailer yet, but this is exciting stuff. No, I am speechless. I'm preparing for this weekend, but a lot going on. I don't even know where to start. I kind of feel like the London Film Festival might be the most exciting one out of all of those.
The America's Cup. You're going to.
You're like, correction.
The Spanish connection. I would have thought you'd be all over that one. So yeah, this afternoon we need the weather to be bad. That is the critical thing. We want it to be blustery, so that our boat performs better. Anyway, that's it for the opening trade. That's the opening trade for this week. We'll be back, of course, next week. We've got an interesting week next week coming up. We also have Joe Biden about to arrive in Berlin. We'll be bringing you those live pictures throughout this morning. Have a great weekend, everybody. This is Bloomberg.